Welcome to Manifested Publishers. My name is Mr. Dongo. I am an economics lecturer. Today we'll be covering that is Economics August 2024 paper, question 4, and we start with Roman A. We read the question, then we put it on the board. It says this: state 5 factors that limit the success of economic integration in developing countries. I repeat, state 5 factors that limit the success of economic integration in developing countries. State 5 factors that limit the success of economic integration in developing countries. So state 5 factors that limit the success of economic integration basically in developing countries. Developing countries, first of all, are countries that are not yet developed. They're in the process of developing. And when you talk about economic integration, we talk about these countries coming together basically to facilitate trade amongst member states. And you said one of the examples of this economic integration, a given example is like the COMESA, where you find developing countries coming together in order to facilitate trade. A given example of economic integration is COMESA, where countries come together to facilitate trade amongst member states. In the quest to facilitate trade and facilitation of cooperation amongst member states, the number of factors that basically hamper such integration. And some of the factors that we know basically does that is lack of trust amongst member states. We also have a number of things that deals with political instability, probably in the continent where those developing countries are. We can also talk about the difference in currency, may also hamper such integration. But you also know that there is violation, where you find some other members may violate the agreements that are basically enforced in such integration. We can also talk about some of the reasons that why these integrations may not work is difference in the level of technology. The countries that are probably more developed in terms of technology than other countries, and so with such, they may not be able to engage in such integration. But lastly, we can talk about a number of things like external influence. You can find countries that are not within the integration actually coming in and causes mayhem in such agreements. And therefore, at the end of the day, you find that such integrations are not facilitated. We can put them on the board. Say one, lack of trust amongst the member states, lack of trust amongst the member states. Number 2, we have what we call violation of agreements. We have number 3, very important, we call it external influence. External influence. We can also have political instability, what we call political instability, within the region. Political instability within the region. And lastly, we can talk about what we call difference in currencies. What we call difference in currencies. Difference in currency. We can add one. We have that is difference. What we call difference in the levels of technology. difference in the level of technology. That when we have difference in the level of technology, that may also hamper agreements within the integration. And that is basically how one should approach this very question. And in looking at that question, the examiner is very clear that it needs 5 points. So the 5 points meaning that each point is equivalent to 1 mark. So as you do that, you must make sure that you're within those points and you can provide extra so that you stand a chance that even if you're not in a position to get the second or you're not able to get the third, but you have an extra mark on that, then you'll be able to get the whole question. That is how we basically approach that very question. We pick it on the next question, still on question 4, Roman B. So this is what the question says. Distinguish between debt distress and debt conversion. So we put it down on the board. We put it down on the board. That is B. Distinguish debt distress and debt conversion. Distinguish debt distress and debt conversion. Distinguish the debt distress and debt conversion. One of the things that comes to our mind is when you talk about debt, we need to understand that being in a developing country, and Kenya one of the developing countries in Africa, we need to understand that one of the major policy issues is management of debt. Because you realize that these countries are not able to fund their budget, that most of their budgets are funded through debt. And so therefore, then there's need for proper debt management in such countries. And some of the terminologies when you talk about numbers of issues pertaining to debt, we'll have what we call debt distress, and we have what we call debt conversion. To be precise, when you talk about debt distress, is inability of a country when a country is unable to fulfill its financial obligation. That is the debt distress. When a country gets to a point that is not able to fulfill its financial obligation as a result of the debt, that is what we call debt distress. And debt distress basically will lead to what we call debt restructuring, that you need to restructure the debt as a result of the distress that comes as a result of not being able to fulfill financial obligation. On the other hand, when you talk about debt conversion, we are basically saying that conversion of a short-term loan to long-term loan and vice versa, where we typically we typically exchange debt at sustainable discount. Exchange the debt at a sustainable discount. We can put it down and say debt distress. We say that debt distress is inability, is a country inability to fulfill the financial obligation. That is what we call a debt distress. And debt restructuring, and therefore debt restructuring is required, and therefore debt restructuring is required. You get to a scenario where you are so much faced with the debts that you are not able to fulfill your financial obligation, and therefore what we call the restructuring of debt basically will be necessary in such circumstances. Then we proceed to what we call debt conversion. Debt conversion. What we call the debt conversion. So when you talk about debt conversion, we basically say refers to the conversion, refers to the conversion, refers to the conversion, conversion of short-term debt, debt to long-term debt, conversion of short-term debt to long-term debt, and vice versa, conversion of the short-term debt to the long-term debt, and vice versa. Or we can basically say that exchange of debt, what we call exchange or stock exchange of the debt. We say stock exchange of the debt, typically to a sustainable discount. Typically to a sustainable discount. That is what we call a debt conversion. That is what basically we call a debt conversion. And very important to understand again on these very questions that we have, very important to understand is that if the marks is allocated 4, it therefore implies that once you define the debt distress, that should account for 2 marks, and debt conversion 2 should also account for the 2 marks. That should also account for the 2 marks. And that's a question that is doable and manageable. And if you look at this, this is one of the areas that actually affect, is one of the emerging issues, especially to the developing countries, and is one of the areas that learners need to pay attention. Because if you look at these countries that are developing, Africa and having a majority of the countries that are developing, they're faced with a number of debt issues. And so we need to give much attention to that. That is how we approach that very question. We'll pick on our next question. That is August 2024. That is question 4, Roman C. We'll read the question, that we put it on the board. Outline 6 method that may be adopted to clear external debt in developing countries. Outline 6 methods that may be adopted to clear external debt in developing countries. We raised and said that debt is a major policy issue, meaning that debt is a factor that needs to be considered. We said majorities of these countries that are in developing world rely mostly on debt. Why that? The reason is that because they're not able to fund their budgets using their own sources of revenue. And so they have to rely on debt that is basically from developed countries in order to fund their budget. So the examiner clear is asking us, how do we get to reduce? What are some of the methods that we get to clear external debt? Because these obligations actually affect the growth of a country. So we can put that on the board. Outline, that is C for C. Outline 6 methods. Outline 6 methods that may be adopted, to clear external, debts in developing, countries, something very important to understand about when you talk about debt management, those are basically touches on macroeconomics. And this is one of the areas, again, also, you're not so much limited into approaching these questions. It's not limited to what you find lecturers will give, but this is a very open way. If we look at our country, for example, Kenya as a case study, What are some of the ways that are very common in a country dealing with clearing external debt? One of the very common that we know as the citizens of a country is that, that the country uses, Kenya being a case study, is widening of the tax bracket. One is what we call it widening of the tax bracket, tax bracket. That essentially means that i.e. increasing the taxes, i.e. increasing the taxes. That one of the ways that they deal with the external debt when it's too much, and how they manage it is increasing the taxes. We know that number two is what you call austerity measures. Where government reduces. Also a measure, Kenya being a case study, we know that a country is dealing with a lot of austerity measures where a country is reducing expenditures. Number two, reducing a country's expenditure, so that much of the money that is available can be used in order to pay the debt, And very important, number three, we talk about debt conversion. And debt conversions, we basically say that you can convert short-term debts to long-term as a way of reducing. So we talk about number three, what you call the data conversion, i.e. converting short-term loans to long-term loans, and vice versa, to long-term loan and vice versa. Converting short-term loans to long-term loan and vice versa. We know that when you talk about long-term loans basically take a longer time for them to be repaid or for them to be cleared. A country may decide to dealing with this long-term loan and making them short-term so that they can clear them within the period. So we can also talk about what you call increasing government borrowing. Increasing the government borrowing. You can also increase the government borrowing in terms of internal. You can increase the government borrowing in terms of internal so that you can repay the external debt. Increasing the government borrowing, increasing the government borrowing from central bank to clear external debt. But very important, one amazing thing that a country can do. A country can also decide to seeking what you call debt forgiveness. Seeking debt forgiveness. The number of points that you could be asked where we say a country can refuse to pay debt as a way of doing away with the external debt. But the most precise and most clear way is seeking of what you call debt forgiveness. But you can also touch on what you call promoting investment so that they can have money to pay the debt. Say promoting investment so as to generate profits to pay up the debt, to pay up the external debt, so as to pay up the external debt, so as basically to pay up the external debt, that they can promote investment within the country so that they can so that they can pay up the external debt. So they can also decide to avoid rescheduling of the loan. But that basically touches, because you can have it, touches on conversion, avoiding what you call avoiding rescheduling of the loans. We can have that as the last, avoiding. We can have it as avoiding rescheduling scheduling of the loans, so as to pay them, to pay up in time. So as basically to pay up in time, that the country can decide to avoid rescheduling of these loans so that they are able to pay them up within the required time. That is how we basically approach that question on how do we reduce, what are some of the methods that basically we use to reduce the external debts. We'll pick it on our next question. That is August 2024, question 4, Roman D. This is what the question says. Highlight 5 limitations of quantitative theory of money. Highlight, we put it down. Highlight, question 4D, highlight 5 limitations. 5 limitations of quantitative theory of money. Highlight 5 limitations of quantitative theory of money. So we need to understand what basically quantitative theory of money talks about. So when you look at quantitative theory of money, it basically talks about MV, which is money supply times velocity, is equals to price levels times the number of transactions, A number of limitations that are basically envisioned in this theory are that the theory does not address one of the limitation. We say number 1 limitation, the theory does not address the issue, what you call the issue of interest rate. Does not address the issue of interest rate. And we basically know that interest rate is one of major policy on monetary policy. Monetary policy that we know we use to address a number of issues, in economics. We can also have number 2 limitation on this theory. The theory does not address the future. We basically say the theory does not address the future. This theory does not basically touches on the future. The theory does not address the future. Then we can also talk about is too much concerned. Number 3, we can say too much. We say too much concerned with money supply. Too much concerned with money supply, that is circulation of money supply, and ignores the demand for money. So when you look at the formula, one of the things that we have on that theory, it's concerned money supply times velocity is equals to the general price levels times the number of transactions. So this theory basically focuses on issues to do with the supply of money, but ignores what you call the demand of money. Then the theory does not explain changes in the value of money. We see that the theory does not explain the changes, what you call the changes in the value of money, in the value of money, does not explain the changes in the value of money, and not how money does not explain. The theory does not basically that attempts to explain. This is basically a term. Attempts to explain. Say attempts to explain changes in the value of money, but does not. But not how. But not how. We say not how. We say not how money attempts to explain changes in the value of money, but not how money is in the first place determined. How money in the first place determined. Not in the first place determined. We can look at the last when we have the last on that. This theory argues that there's no general price level. Argue that 5 argues that there is no general. There is no general. Argues that there's no general price level. Price levels. But rather, we say but rather series. There's no general price level, but rather series of price levels, series of change in price levels, series of change in price levels, series in change in the price levels, in the consumer price index, in the consumer price index. So those are basically some of the limitations that are basically attached to the theory. That is the theory of quantitative money, or theory of quantitative theory of money. One we've talked about does not address the issues to deal with interest rate. We also know that it does not address the future. We also understand that is too much concerned on money supply and ignores the aspect of demand of money. We know that the theory attempts to basically explain the changes in the value of money, but does not address how money in the first place is determined. How in the first place it's determined. That is how we approach that very question. That marks the end of question 4.
Reporting on compliance. Here we are referring to the auditor reporting on the compliance status of the company that is auditing, also known as compliance auditing. Now, compliance auditing is a specialized area of auditing that focuses on assessing an entity's adherence to specific laws, regulations, industry standards, and even a company's its own policies. So the auditor may be required to report on compliance status. Does the company adhere to specific laws, regulations, industry standards, its own accounting policies? So it is often required for entities. It is always, let me put it this way, it is a requirement for companies in highly regulated industries such as banking, insurance, healthcare, and so on. The auditor has to give a report on compliance. You understand? So, apart from just giving an opinion on the financial statements of an entity, the auditor may be required to do what we call compliance auditing. Look at the company's adherence to laws. You get the meaning? So then what would be the considerations when reporting on compliance? If you are to report on a company's compliance, what are the considerations? One is a scope. Before you embark on compliance auditing, the scope has to be clearly defined. Clearly define the scope of compliance audit, including the specific laws, the regulations being assessed, and so on. So you have to put down all the laws that the company is required to adhere to, get the scope. Then materiality is another consideration. Evaluate the materiality of any non-compliance, because candidates non-compliance may come at a cost. So identify the materiality of non-compliance. So we all know that companies operate in highly regulated environments. Failure to adhere to laws comes with what we call compliance risks. So the auditor has to evaluate the materiality of non-compliance. Evidence, the third aspect, evidence. If you are to do compliance reporting, then you have to obtain sufficient appropriate evidence to support audit conclusions on compliance. Evidence. Then we have reporting. You have to consider reporting requirements. Reporting requirements. The auditor has to determine the specific reporting requirements for the industry or requirements laid out by regulatory bodies. You understand? Consideration, scope of compliance auditing, materiality, evidence, reporting requirements. And the candidates, there are two types of compliance reports. Generally speaking, there are two types of compliance reports. We have the direct and indirect. Direct and indirect. There are two types of compliance reports. Direct reports, where the auditor expresses an opinion on the entity's compliance with specific laws and regulations. In an indirect compliance report, the auditor provides information on the entity's compliance with laws and regulations as part of their audit of the financial statements. As part of their audit of the financial statements. You get the difference? As part of their audit of the financial statements. So apart from giving an opinion on the financial statements, the auditor also has to provide a compliance report. So currently we are discussing compliance auditing at the reporting stage. At the reporting stage. So a compliance report will, just like any other audit report, will have an opinion, it will have a scope, it will have findings, and even recommendations. But most importantly, a compliance report is a specialized area that requires specific knowledge and expertise. And therefore, the auditor should ensure that they have the necessary qualifications and experience to perform such engagements. Are we clear on that? Still on reporting on compliance and other information, because the subtopic here is reporting on compliance and other information, we have the chairman's statement and director's report. Chairman's statement and director's report. At the conclusion of an audit, the auditor is also required to evaluate the chairman's statement and the director's report. But first of all, what is this chairman's report? What is a chairman's report? What is a director's report? The auditor is required also to provide an opinion on the chairman's statement and the director's report. But what is a chairman's statement? Now, the chairman's statement is, to put it plainly, it is a narrative report that provides an overview of the entity's performance, strategies, and future prospects. Chairman's statement is a narrative report that gives the entities strategic direction, performance, and what else? There's a third thing. Strategic direction, it will come to my mind. So it is a chairman's statement in a narrative. It is in a narrative form. The report is in a narrative form that gives the entities, first of all, strategic direction. Then you have performance, yes, and future prospects. So at the end of the accounting period, a chairman is required to issue a statement. This is a chairman of the board of directors. The chair of the board of directors has to give a statement. And this statement, we are calling chairman's statement, has to be included in the annual report along with the financial statements. It's included in the annual report along with the financial statements. That is the chairman's statement. So here we are discussing the chairman's statement and director's report, and say that auditors, at the conclusion stage of an audit, auditors are required to provide an opinion on the chairman's statement. The chairman issues a statement at the end of the accounting period where the chairman highlights the company's strategic direction, we have the company's performance and future prospects. And this statement has to be included in the annual report along with other financial statements. You understand? So auditors are generally not required candidates to provide an opinion, generally speaking. Generally speaking, auditors are not legally required to give an opinion on the chairman's statement. But they may be asked to review this statement for consistency with the financial statements and for any material misstatements or any inconsistencies, because the chairman may, in providing this statement, provide information that is not consistent with the financial statements. So that's why the auditor, though generally is not required to give an opinion on the chairman's statement, there are times when he may be asked to do so. So it's important to note that it is not a legal requirement. It is not a requirement that the auditor provides an opinion on the chairman's statement, but at times when he may be called upon to do so. So candidates, as we are discussing the chairman's statement, it should not be lost on you that we are discussing the topic concluding and reporting. At the concluding and reporting stage, this is what happens. The chairman has to develop a statement. Now, when reviewing the chairman's statement, this is the most important question for us here, because you are to take the position of the external auditor, and that is the position of even your examiner. For those of you who are doing exams, if you are studying the chairman's statement, concluding chairman's statement, what is important here for you is to assume the role of the external auditor. If you are to give an opinion on the chairman's statement, then what are some of the things that you may consider? That's what's most important here for you. Now, considerations. Assume the role of the external auditor. But I think I gave you a hint on the considerations, what you ought to consider when reviewing the chairman's statement. One is consistency with financial statements. Consistency with financial statements. The chairman's statement has to be consistent with the financial statements. So when reviewing the chairman's statement, the external auditor has to ensure that the chairman's statement is consistent with the financial statements and the auditor's opinion. It has to be consistent. 2, check for any material misstatements. When reviewing the chairman's report as an external auditor, you have to check for any material misstatements. Identify any material misstatements or inconsistencies in the chairman's statement. 3, we have disclosure requirements. Disclosure requirements. Disclosure requirements. The external auditor has to verify that the chairman's statement complies with applicable disclosure requirements. What does the law say that the chairman's statement should contain? So there has to be disclosure requirements that are met. Then, of course, you can look at the overall presentation. Overall presentation. Now, overall presentation here, the auditor looks for clarity, objectivity, and relevance. So when reviewing the chairman's report, you have to assess the overall presentation of the statement. I mean the chairman's statement, including the clarity, objectivity, and relevance. And if the auditor identifies any significant issues with the chairman's statement, the auditor should discuss such issues with management and consider whether they need to be disclosed in the audit report. So if there are issues that the auditor identifies or inconsistencies in this chairman's statement, then that has to be discussed with the management and a decision be made whether such discrepancies or inconsistencies or the material misstatements in the chairman's statement could be or should be included in the audit report. So that is the chairman's statement. The same can be said in relation to the director's report. Director's report. Maybe we need to mention something about the director's report. Director's report. Director's report. Before that, is there any question on the chairman's statement? And here this is the chairman of the board of directors. We've said that is part of the annual report. It is a key component of the company's annual report. The director's report also is a vital component of the company's annual report, and it provides shareholders and other stakeholders with comprehensive overview of the company's performance, financial position, future prospects. Now, the chairman's report primarily provides high-level overview of the entity's performance and strategies and future prospects. And I've said it is written by the chairman of the board of directors. But the director's report provides a more detailed overview of the company's performance, financial results, risk management, and governance. So the director's report is more detailed. The issues are the same, but the director's reports go into details. It's more detailed. It is a more detailed report to give the specifics. But the chairman's statement is just a high-level statement. It is an overview but the director's report provides detailed overview. Detailed overview. Do you get the difference? The chairman's statement, I repeat, the chairman's statement is a high-level overview, but a director's report is a more detailed overview. It is more formal and factual. It is more formal and factual. The director's report is more formal and it's factual. And it follows a structured format that includes specific disclosures that are required by regulations. It has specific disclosures. Specific disclosures. Do you get the difference? It is prepared by the board of directors as a whole, the whole board. You get it? This one is prepared by the chairman alone, but the director's report is prepared by the board as a whole, directors, including the chairman. So it is more detailed, it is more factual, and it gives specific disclosures as required by regulations. So both candidates' reports provide information about the entity's performance. And while both provide information about the entity's performance, the chairman's report offers a broader and more strategic perspective, while the director's report delves deeper into specific aspects of the entity's operations, specific aspects, entity's operations, and even governance. But sometimes candidates in some jurisdictions, these two are just combined into one. There are times when they are separated, but they may also be combined just into one, into a single document. And I've said that while the auditors are generally not required to provide a formal opinion of the chairman's statement of or even director's report, they may review the documents for consistency with the financial statements and for any material misstatements or to check the disclosure requirements, and just to look at it and ensure that the reports are and the statements are clear, concise, and all that. So all these considerations also apply to the director's report. The considerations for chairman's statements are just the same for the director's report.
And we talk about interest in land. Interest in land can take the three the three forms. It's either an estate, a servitude, or an encumbrance. It may be freehold or leasehold, and a freehold land confers rights for an indefinite duration, and you can inherit, and it can also be transmitted. You take the example of ancestral land. It was before you were born, a generation came into existence, that generation passed on, another generation inherited, we are currently there, and the future generations will also inherit it. And freehold estates include a free simple. A free simple is the largest freehold that a person can have on land at common law, and it confers the largest quantum of rights, unrestricted right to use, misuse, and dispose. And in the event of death, the rights are transmitted to the person entitled to inherit the estate, and there are no conditions attached to the inheritance, and it can be disposed by deed or will, wholly, in part, unconditionally, or conditionally. And we'll refer again to that ancestral land. You find that it may be divided amongst the sons. The sons again will divide amongst the children. It continues in that way. And there is no, you dispose it by use of a will, and you can dispose it fully, or you say leave 2 acres for plantation. Leave 2 acres and make sure you plant trees. These 2 acres can never be tilled. These 2 acres can never be built upon. And a fee simple is either by grant or inheritance, as we have said, or where the government has leases. Upon the expiry of the leases, think about these white settlement schemes, whereby upon the expiry, the land automatically reverts back to the state. And now the state can decide whether to apportion it or increase the lease term. We talk of a fee tail, and it confers a life interest on the holder, and it descends only to specified persons. And this is generally created by inheritance. What you buy and want to pass on to your future generations, or what you buy and you want to gift someone, and they hold it so that they're able to transfer it in future. And for freehold, we talk about absolute proprietorship, and it is upon registration. Registration will terminate all customary rights exercisable on that land. This is where you've bought and you take the documents, a transfer is done, you take your ID, the old title deed, take it back to the lands, and you're given your new title deed in your name. And for estates, we also have leaseholds, and we consider them tenancy. And a lease is a transaction which creates the relationship of a landlord and tenant. And the formal document is what is called a lease. Leasehold is the quantum of rights which a lease grants on the lease. It's a secondary interest in land derived from a primary interest. And it confers upon the lessee exclusive possession of another land. And when we say it is a secondary interest, if the property you have, and it's a leasehold, and it says 99 years from the time you bought it. Let's say you bought it 3 years ago, and you are granted 99 years. If you sell it after 5 years, you can only sell the 99 minus 5. You cannot grant any more than what you have. And the characteristics of that is that there's exclusive possession. A tenancy will confer upon the grantee the right to hold to the exclusion of others. It means there will be no interference with how you carry on the business in your land. And we also talk about a defined premises. It's not arbitrary. It's not ambiguous. It is determined on a specific piece of land that is well known, that can be identified, that you can actually pinpoint and say, this is my piece of land, and the documentation proves that it is that one, and it is for a certain period. We've said 99 years. It could be 199, and that the reason it is not rounded off to 200, that last year, when it remains some few months, you're supposed to take it back and renew the leasehold. And the types include a fixed tenancy. This is a fixed duration. We are doing this for 10 years. That is fixed. And that's the commencement and termination must be specified. So we will put it in writing that starting the first day of November 2024, and it will run up to October, 30th October 2029, both days inclusive. So that is specified. It's not left up until either party decides to terminate. There's also a periodic tenancy, and it's indefinitely from a period to period. We put it open that once 1 year is done, we can continue, we can proceed to the next year, and it may be expressed or implied. So there's also a tenancy at will, which will terminate in the event of death. This tenancy at will, it is for as long as you and I have this property, you and I are agreeing to the terms and conditions. So where none of us or one of us is not present, then that tenancy terminates. There's also a tenancy at sufferance, where it's created by law, and there's occupation without the landlord's consent. So the law forces this relationship, but where you pay rent, then it becomes periodic. And the problem with tenancy at sufferance is that the tenant may be elected at any time without notice. We have the obligations of the parties. In a leasehold, we have the lessor and we also have the landlord and the tenant. And the duty of the landlord is to ensure quiet enjoyment. Do not disturb your tenant. You do not interfere with their right to enjoy what they have paid for. And this means you don't put restrictions. If they had intimated they need parking, you don't go harassing them and telling them, no, don't park on this grass, do it there. You don't also impose your beliefs. If you are Christian and you go to church and now you want to knock on your tenants and tell them, no, we have to all go to church, or anything that may be construed as disturbing their right to enjoyment, that one is not allowed. And as the landlord also, the premises must be fit for purposes. If it is a house, it must have proper sanitation, it must have proper ventilation. If it's a business premise, again, proper disposal of waste. The reason to which it is being let, it must be fit for that. There's also the duty to repair, such that if the doors are falling apart, the landlord must ensure the premises are kept in a manner likely and to ensure enjoyment of rights. If there was a door at any given time, then he cannot come and remove the door and say today it will be like this. No, they need to ensure there's the right to enjoy and the right to repair. So now that we've seen the duties of the landlord, what about the tenant? And one is to pay the rent. And it is paid irrespective of occupation. What this means is, if you say that from January 2024, I am occupying your your premises, George. Then I decide I will live in, I will move in after 3 months. I will move in March. If I am your tenant, whether or not I am occupying, but we had agreed from January. So I am supposed to pay, I am obligated to pay for the entire period, whether or not I have occupied the said place. The tenant is also not allowed to transfer, to sublet, or part with possession. You cannot give again what you do not have. If the property is not yours, you can't rent it out to someone else. You don't have the capacity to enter into an agreement with a third party because yourself, you're already in a contract with the owner, with the landlord. So you cannot again purport, because of the rights you have accumulated or acquired as a tenant, to look for another tenant to be under you. You're also allowed to permit the landlord to view the premises, and this will go hand in hand with the repairs, ensuring that there's the right to enjoyment. And there's also a duty not to erect fixtures. That is, you're not allowed to, let's say you've rented a standalone house and you assume you can put up a business for selling ABCD. Then you want to put up that shed. You're not allowed to do that. And these rights and duties to the parties. Remember, a tenancy agreement may be written. So these are general ones, but where there's a tenancy agreement, whatever you sign, whatever you bind yourself to, is what you will rely on in the day-to-day. If you had agreed rent is due on 5th, then you are bound by that. Rent is due on 5th. If you had agreed you can only let the landlord in on Saturdays during working hours, and the landlord agreed to that and gave you his house, then that is also what will happen. So while what we are saying is the general, the nitty-gritties, the finer details will come on that contract you have agreed with the landlord or the lessor or that owner of the property. So leases do terminate, and one is by notice. And this notice must be clear that within a month, I want you out of my premises. So I'm not giving you room to negotiate. I'm not giving you room to tell me we can add rent. No. Simply within a month, kindly move out, hand over the keys to the gate man, remove all your property. There's also the element of surrender, and it must be in a prescribed form. So the tenant surrenders to the landlord and the landlord agrees. And a license differs from a lease in that a license is a permission given by the occupier of the land without creating an interest in the land that allows the licensee to do some act which would otherwise be a trespass. And a license does not confer the right to exclusive possession of the land. It's a mere permission by a party to another to enter the licensor's land, and it does not require any writing or registration, and more importantly, it is not transferable. License, you can imagine where you're given a license to extract something from the land. It's different from tenancy because you're only there for that specific role. You don't get to do anything else apart from what has been agreed on. So an interest in land, we have talked about estate, and now we will talk about servitudes. And servitudes are rights conferring a power on another's land for the benefit of the right holder or his estate. And they include easements, profit apprender, and restrictive covenants. Easements are rights attached to a parcel of land which allows the proprietor to use the land in another, to restrict its use to a particular extent. And an easement may be positive or negative. So it's positive if it authorizes the use of another's land in a particular way. Negative, think of restriction. It restricts you from acting in a particular manner. And easements that they must be dominant. And rather, there must be a dominant and a servient tenement when it comes to easement. So two aspects of that need to be in existence. And they must be occupied by different persons. This is because an owner cannot have easement over his land. And easements are created either through express grant. The rights to the grantee are prescribed in a manner, also through statute granted by an act of parliament. Lastly, will be upon prescription, where the Limitation of Actions Act says that 20 years of continuous use of another's land grants an easement to the user. The law may have been updated, but that element of continuous, without giving the owners any breathing space. And these use, in these, think of squatters, that when they come and you make no effort to evict them from your property, the first year passes, the second year passes, children grow, families widen, then you are not allowed to, after a period of time, to say that, no, now you move. So there's that Limitation of Actions Act. It prescribes for how long can someone stay unwelcome in your land before they claim ownership of that similar land. And easements are terminated through lapse of time. We also terminate them due to the occurrence of an event. And this occurrence is a breach of terms, where something has happened that the terms have been breached. We also talk of the registered, a judicial discharge, where the court is empowered on application by an interested party in order to terminate this easement. If there's a justification, a proper justification, a reasonable cause as to it to happen. Profit apprender is the right to take something off another's land. That you have a neighbor, you have seen that he has started digging up gold deposits, and you want to go to his property and take those gold deposits and sell them and gain money. And if you get this profit, then it should be profit in common with the person whose land you went and took something from. And it may be created or acquired through express grant, prescription by law, and we terminate the profit apprender by release or abandonment. You just let it go. You say it's not worth it and you move on swiftly. Encumbrances constitute burdens on the property, and they're generally temporary. These are either mortgages or charges. And a mortgage is a conveyance of land or that is used as security for payment of a debt or the discharge of some other obligation for which it's given. And one of the characteristics is that the title to the mortgage, now you can no longer transact using your title, because up until you're able to pay off the amount given, then that mortgage company owns either that house or that piece of land in which you want to build. And we have a simple mortgage transaction without delivering possession of the mortgage property, and the borrower binds himself to pay. And where there is non-repayment, the mortgagee shall have the right to sell the property and restore himself to the position he was in if you are not introduced to each other. There's also a mortgage by conditional sale, where the borrower sells mortgage property to the mortgagee on condition that even in the event of default, the sale becomes absolute, or in the event of payment, the sale becomes void. This is where we are saying you owe microfinance, a certain microfinance, 60 million shillings, and you've not been able to pay. The fact that you are unable to pay, then the property will be sold, and that sale becomes absolute. There's nothing you can do when you have agreed to have that mortgage by conditional sale. You advanced money, you buy the house, but you deliver the title to the person issuing you with the mortgage. That in the event that you default, then that sale becomes absolute. But should you pay, the payment makes that sale void. You as the mortgagor or the charger, you're supposed to pay the principal interest, pay all taxes on that land, to keep the premises in repair, to ensure that in the joint names of all the parties, and to honor the terms, how you agreed to having a mortgage. Then you honor the terms and make sure that you pay.
Welcome to Manifested Publishers. My name is Mr. Dongo, Public Finance and Taxation Lecturers. Today we will be handling April 2024. That is the block revision, and we start with question 3. We'll read the question, then we put it down. Explain the applicable rate and the due date for the affordable housing levy. We say explain. One is explain the applicable rate and the due date for the affordable. We call it the affordable housing levy. For the affordable housing levy. We say that affordable housing levy is basically the mandatory contribution. That is the mandatory contribution from both employer and employee towards building what we call the affordable housing. We call it the mandatory contribution, one of the statutory deduction by both employer and employee towards building of the affordable housing. But the question is very specific. What is the applicable rate? The applicable rate we know is that should be 3%. That is 1.5 from employer, and 1.5 from employee, 1.5 from employee. So that is the rate, 3%, or you can say 1.5 from the employer and 1.5%, 1.5% from the employee. And the second part of it, because this question basically had two parts, the due dates for the affordable housing. We say that the due date is, we say 9th of the following month. 9th of the following month. And this, you remember, is also the day that also payee, which is statutory deduction, should be submitted. So that is the 9th of the following month. That should also be the due date. So by saying 3%, we're just expounding 1% by the employer, 1.5% by the employer, and 1.5% by the employee. That gives you the first part of it. The second part of it is the due date. And the due date we have said is 9th of the following month. And that is how we conclusively answer that question 3, Roman A. Question 3, Roman A. Question 3, Roman A. We proceed from the next question. That is question 3, Roman B. We read the questions, then we put it down. Explain three ways through which individual could engage in tax avoidance. 3B, explain 3 ways an individual, we say could engage in tax avoidance. An individual could engage in what we call tax avoidance. The first part of the question is basically to understand what the question basically asks. So the first thing is to understand they need 3 ways or 3 modalities in which an individual can engage in tax avoidance. Number 1, what is tax avoidance? We say that tax avoidance is what we call a legal means through which a taxpayer can minimize the tax burden. And so this calls on a very good tax person, that you can look at the tax system and identify some of the loopholes that are basically there in the tax system and take advantage of them in order to minimize the tax burden. If it's noticed, for example, that you are avoiding taxes, that you are engaging in tax avoidance, we know that for sure that penalties and interest will not be constituted because tax avoidance is basically legal. But of essence is that when the Kenya Revenue Authority maybe identify that the loopholes are very huge, they can decide to seal those loopholes. But you say that the taxpayer will not be instituted for what you call penalties and interest when it's noticed that is avoiding taxes. Number 1, we can talk about the area of allowable deduction. For example, if you're contributing to pension, if you're contributing to a registered pension scheme, we say that it's allowed to a set limit of 240. That is, you're going to compare the actual amount with a set limit of 240, and you also compare with the third thing, that is 30% of the gross employment income. And the law of the 3, you can use it to lessen your tax burden. So number 1 is what we call allowable deduction. We call it allowable deductions, i.e. pension, i.e. contribution to pension schemes. We say it is allowable allowable to a set limit of 40,000 per annum. And that is to say, you compare the actual amount, 30% of the gross employment, and the set limit. We say that the set limit of 240 per annum. So you compare those three, you pick the lower. Still on the allowable deduction, we say mortgage interest. Mortgage interest. If the interest that basically accrue from a mortgage that you take from a reputable organization like the bank, we know that it's allowable. We say allowable to a set limit, of 300,000 per annum. So you can have it, just to expound it deeper, we say actual amount, you'll have the actual amount, the figure there, and then you compare with the set limit. We have the set limit, which is 300,000 per annum. So you pick the lower. So that is the first area that an individual could basically engage in what we call tax avoidance. The second way an individual could engage investing in areas where withholding tax is a final tax. Investing, we can talk about investing in areas where we call it where withholding tax is final tax. So what are these areas? I.e., we call it qualifying dividends, and qualifying, what we call the qualifying and the qualifying interest. So the withholding tax on the such incomes is basically what we call the final tax. The third one, you can talk about a person deciding, we can talk about deciding whether to engage in local sale or export. Deciding whether to engage in local or export sales. And we say that we know that export is normally zero. We say zero rated, implying that one will not be charged VAT if he or she decide to engage, in export, that one will basically not be charged VAT if one decide to engage in export. And therefore, if one goes for the export, then definitely is not going to go for VAT. Then we can have number 4, just expounding, making a decision, what do you call a decision in financing, i.e. whether to finance through debt or shares or ordinary share capital, share capital or ordinary share capital. So a taxpayer, you just say a taxpayer should finance through debt, since interest on debt is treated as allowable deduction, because interest on debt is basically treated as allowable deduction. Then you can have the last one, which is 5, claiming, what you call claiming investment allowances. So on this option, a taxpayer, for example, may decide whether to lease or to buy an asset. And if you buy an asset, which is a capital expenditure, you can claim for what you call investment allowance. Just something for learners maybe to expound more on this, Apart from this, you can look at now what you call the tax evasion and how the impact of tax evasion, why do people evade taxes, and how can one prevent what you call tax evasion. This is tax avoidance, which is legal. But now as a point to maybe push, as a point maybe to understand, one of the areas that are very key in the economy, because a lot of people engages in tax evasion. You need to understand what tax evasion is, what is the effect of tax evasion, and why do people engage in tax evasion, and how do we seal loopholes that are basically in the tax evasion. If we look at that is August examination, the questions that pertains to tax and how one would minimize what we call tax evasion. That is how we basically answer that question 3, Roman B. We proceed on the last part of question 3, that is 3, Roman C. And this is basically on employment income. So we are told that there's a gentleman called John Musyoka. He's employed as a finance manager by Safari Real Estate. He reported the following details of his income and that of his wife for the year ended 31st December 2023. So number 1, we're being told that he was entitled to a basic salary of 400,000 per month. Then we have into bracket payee of shillings 120 per month was deducted. So in this question, the gross salary per month is basically 400,000, and then there's a payee. And payee, you need to mark, if you're listening, you need to mark that the payee is what you call a tax credit or a set-off, We less them directly from what you call the gross tax payable. And number 2, we are being told that it was entitled to an annual bonus of shillings 120 during the month. The bonus for the year was, however, not paid until February 2024. Just as I retract back, I say that when you talk about basic salary, we need to understand that that is a taxable income. Number 2, even for the bonus that is not paid, that is an accrued income. So basically that is a taxable income, and we are taxing it in 2023. Though it's paid in 2024, but you tax it in 2023. We basically tax it in 2023. So we proceed to the additional information. Number 3, the employer provided him with the motor vehicle of 2,600 cc that had a cost of 3.2 in the year 2021, and the vehicle was valued at 2.5 at the beginning of 2023. Number 1, we have a benefit that is called motor vehicle benefit. And the motor vehicle benefit, we basically say 2% times the number of months that the motor vehicle has been used. Then you say times what you call the initial cost. 2 things that you need to take away home. The examiner has basically given the net book value at the beginning of the year 2023 and the initial cost. Don't use the net book value. You use the initial cost, and in this case, the initial cost is a figure of 3.2 million. The initial cost is a figure of 3.2 million. In some cases, if we redraft this question, in some cases, you will have the examiner saying that, the net book value was 2.5 and depreciation was 700. So you need to add back that depreciation, which is a non-allowable expense, to get back the initial cost, So that is what you need to do. But I've said that motor vehicle benefit is a taxable benefit. Motor vehicle benefit is a taxable benefit. Then you're being told that is annual mortgage repayment of shillings 820 inclusive of interest. Annual mortgage repayment inclusive of interest of 180 was settled by the employer. If a mortgage is basically settled by the employer, that becomes a benefit. If a mortgage is settled by the employer, that basically becomes a benefit. But if I draft a working, just a small working here, as I say, so the mortgage is about 820. Out of it, we can less 180. This is on mortgage. We less 180,000. We have a figure of what you call 620. So 620, 640, sorry, that should be 640. If we less that, 640 is what is the mortgage. So this mortgage repayment, mortgage repayment is a benefit. Why? Because it's paid by the employer. But for the interest of 180, we treat as what you call allowable deduction. We treat it as allowable deduction. So the mortgage repayment of 640 is a taxable benefit because it is basically paid by the employer. Then we have the next. We are being told that the loan was obtained from Elite Bank on 1st January 2023 to purchase on residential. So we proceed to the next. That is 5. We are being told that the following deductions were made from his salary. One is subscription to Jenga Golf Club. The figure is 66. And then we are told contribution to a registered pension. So contribution to a registered pension is allowable deduction. However, subscription to Jenga, what you call the Jenga Golf Club, to a Jenga Golf Club, if it was deducted, it does not relate to his work. However, if the examiner would have said that that was subscription, probably to ISPAC, because ISPAC, these are finance managers, these are basically accountants, that would have been allowable deduction provided that it was not reimbursed. So the subscription to Jenga Golf Club, it's not allowable deduction. But contribution to a registered pension, that deduction becomes allowable deduction. And you know that set limit is basically 240. Then lastly, for John Musyoka, that is until 6, he received a gross dividend of 80,000 from his shares in Safari Real Estate Limited, where the withholding tax was paid by the employer. So the withholding tax that is basically paid by the employer, with this one you could have called working one. Withholding tax payment, what you call withholding tax payment by the employer, is a benefit because that was paid by the employer. So what is the withholding tax basically on shares, on a dividend of 80,000? That should be 5% because it's a qualifying. Remember, that's qualifying. The 5% withholding tax is final. So get the 5% of 80,000. If you get 5%, we pick our calculator. And say 0.05 times 80,000. So the withholding tax benefit that was paid by the employer, which becomes the taxable benefit, is 4,000. Hold it there. Before we move to the wife, we proceed down there. We hold it until additional information number 6. So we move to the required. Compute the taxable income for John Musyoka and his wife for the year ended December 31st. Then the second part, determine the tax payable. Then you're being told in 11, that is 10, that John Musyoka and his wife, Janet Musyoka, have been filing separate tax return to the Revenue Authority. So this basically gives us a direction that we need to compute what we call taxable income for John Musyoka and the wife separately. So we hold it on 6 as we do Musyoka. Then we get from 7, we look at Janet Musyoka. So we say John Musyoka, we call it John Musyoka, John Musyoka, Musyoka. We have the John Musyoka. Taxable income, taxable income for 2023. So we start with the first one, that is the basic salary. Basic salary. So the basic salary is 400,000 times 12. So 400,000 times 12. We have a figure of 400,000 times 12. So that should be a figure of 4.8. That should be a figure of 4.8. So the next one we had was annual bonus. That bonus is also taxable. So bonus is 120. Bonus is figure of 120. Then we have motor vehicle benefit, MV benefit. How do we calculate? If the motor vehicle is owned by the employer, 2% times the number of months, which is 12, then times the initial cost, which is 3.2 million, you compare with motor vehicle CC. So motor vehicle CC is basically provided from the tax table. If we are not told the type of motor vehicle, then we use the saloon, hatchbacks, and estate. So the motor vehicle was basically 2,600 cc. Where does 2,600 cc fall? Between 2,000 and 3,000. So for the whole year, that is 103,200. So we get the 2%, 0.02 times 12, then times 3.2, times 3.2. So what do we get? We get 768,000. So we compare between 102,200 and 768,000. Which one is the higher? The higher should be 768. And learners, very important again. Sometimes you're told that the motor vehicle is leased or hired from the third party. If the motor vehicle is basically leased or hired from third party, we need to remember that we do not use this formula. We ignore the formula, but we use the lease value stroke the hiring value. That is if motor vehicle is leased. So then the next we have mortgage repayment benefit. We call it mortgage repayment benefit, because the employer repayment benefit. So for the mortgage repayment benefit, we did the working. That should be 640. That should be 640. That should be 640. Mortgage repayment benefit. That should be 640. So then we have employment. What you call the next is what you call on the next those ones allowable deduction. On 6 we have withholding tax benefit. Withholding tax benefit. It was paid for withholding benefit. So that should be about 5% times 80,000, which we also did get the value to be 4,000. So we get the employment benefit. Employment, what you call the employment benefit. We get what you call the employment benefit. So we add, we have the 4.8 plus 120 plus 768 plus 640 plus 4,000. So the figure is 6,332,000. Then you say we less allowable deduction, less the allowable deductions. So we start with contribution to pension. Contribution to pension, that is registered pension scheme. Contribution to pension, where we're saying actual amount is 180. We compare with 30% of the gross employment income, which is 633,200. 30% of the gross employment income. So times 0.3, we have that to be 1,899,600. Then the set limit, we know that the set limit is 240. We know that the set limit is basically 240. So we pick the law of the three. So what are we lessing? We're lessing 180. We are lessing a figure of 180. We are lessing a figure of 180. Then we proceed to this other end. We look at this other end. We look at this other end. We look at this other end. And on this other end, there's still another allowable deduction, that is mortgage interest. Mortgage interest, actual amount, we know is 180. And then we have the set limit. The set limit should be now what we call 300,000. Again, we pick on this, the lower. If you look at the habit of the taxman, is that the taxman is very conscious, For items that he needs to tax, he wants the taxpayers to pay their IS. For items that basically will reduce the taxpayers' money, he wants the taxpayers to pick the lower. So that is 180,000. We'll less that. So then we get what we call the net employment, what we call the net employment income. We get the net employment income. So we had a figure, as we rotate back, just for that to be seen, we had a figure of 6,332,000 minus 180, that is for the pension. Then again, minus mortgage, which is 180, minus 180 again. So when you minus that 180, we get 5,972,000. Then we add other taxable income. So for Musyoka John, he did not have other taxable income. So we have the final, that is the total taxable income for John Musyoka. That should be the same figure, 5,972,000. That is the total taxable income for John Musyoka. So I would want us to read now for Janet Musyoka. That is now additional information number 7. So the wife is called Janet Musyoka. The wife is basically called Janet Musyoka. And you're being told that Janet Musyoka is basically employed by Bright Farmers Cooperative Society as a general manager at a basic salary of 160 per month. So we can just start Janet Musyoka here. So Janet Musyoka, we have it, Janet Musyoka, taxable, we call it taxable income for 2023. Taxable income for 2023. Then we say that we start with number 1 is the basic. We say that basic is taxable. The basic salary is 160 per month. So we start with the basic, which is taxable. Basic should be 160,000 times 12. To get that, we have that basic salary. So if we pick our calc and just have 160,000 times 12, we have a figure of 1,290,000. A figure of 1,290,000. So the next statement, we are being told that Janet Musyoka, she's housed with a cooperative society farm where he contributes 5% of her basic salary as rent. Then we are also told that she receives a free farm produce worth 24,000. So I start with farm produce. If you receive a free farm produce worth 24,000. Number one, you call it benefit in kind. And we say that in taxation, for a benefit in kind to be taxed, it has to be more than 36,000. So the farm produce that he receives for 24,000, we don't tax it. Why? Because that benefit in kind is not above 36,000. So what do we have? We have a housing benefit. Again, also a point to understand on that particular question, that this housing benefit basically relates to farm. A person who has been housed in a farm. So for that housing benefit, we do not use 15%, but we use 10%. But again, also we are being told that there is his own contribution towards rent. So we just get 10% of the gross employment income. Then you compare with the market value if it's there. Then you get the eye of the two. Then you less own contribution towards rent. Then other incomes. Those do not form part of. These ones do not form part of employment. So we know that employment, housing benefit, we just now get the housing. So we get employment income. That should be employment income. Income is 1920. So then we get the housing benefit. Housing benefit. How do you get housing benefit? This an agricultural employee. So 10% times 1,920,000. There's no market value. Then you less own contribution towards rent, which is 5% times 1920,000 to get the housing benefit. So 10% of that, when you have 10% of that, that would be 192. Then 5%, that is 0.05 times 1920, that should be 96. So 192 minus 96 makes the housing benefit to be 96. So we've said housing benefit, the reason why I'm using 10%, this is agricultural employee, agricultural and housed in a plantation. So we use 10%. So 10% of the employment benefit, which is 1,900,000, we get 192. His own contribution towards rent is 5%. 5% of the basic salary. We less that 5%. We get 192 minus 96, we get 96. So then we have what we call the gross employment income. We have the gross employment income. So the gross employment income, this is 00, this is 6, this is 1, 0. So that is 2 million. 2 million. That should be 2,016,000. That should be 2,016,000. That should be 2,016,000. In this question, we look for allowable deduction. Unfortunately, we do not have allowable deduction for the wife, but we have other incomes. But we have other incomes. We do not have allowable deduction, but we have other incomes. No allowable deduction, but we had other income. So we say add other incomes. Add other incomes. So other incomes, we read them. So other income comprised of the following. Number one, we are told that interest income on a 10-year infrastructure development bond, that is 120. Interest that is basically received from an infrastructure bond is tax exempt. Some of the provisions that were there in the finance bill that was rejected was basically talking about putting a value, putting tax on that. But we do not have interest on an infrastructure bond. So that is tax exempt. We don't include it. Then we have interest from Wema Development Bank. Very keen. I want the learners to be very keen. When an individual receives interest from a bank or an insurance company, we call it qualifying interest. The 15% withholding tax is final. So this one we do not subject to further taxation. But lastly, we are being told that the gross farming income was 270, excluding family consumption. Family consumption in tax, that is what we call non-allowable expense. So farming income is an income that is subjected to further taxation. So we basically add back the 30, which is non-allowable expense. So we say other incomes is farming income. So for the farming income, we have a figure of farming income. We have a figure of 240, but you add back the 30. We add back the 30. We know that that farming income is 270. So until there, we get what we call the last part, which is called the total taxable income. We get the total taxable income. So we have our figure that is 2,016,000 plus 270,000. So we have 2 million. Total taxable income is 2,286,000. 286,000. That is how we sort Roman A. So we proceed to Roman B, which is the last part of it. Tax payable. Tax payable. That is tax payable on incomes. Tax payable on incomes. On incomes above. So we start with John Musioka. John Musioka on one end. John Musioka. So what is the taxable income? Total taxable income. Total taxable income for John Musioka, we had it as 5,972,972,000. So for this, you require a tax table. On every tax paper that you will encounter, the first page is normally a provision of the tax table. Remember, these are incomes for the whole year. So if they're incomes for the whole year, you look at the tax table, there's monthly and there's annual. So what do we use? We use the annual. So on the annual, we're being told, now the first 288,000 we tax at 10%. So 10% of that should be 28,800. Then the next one, we're being told that between 288 to 388, we tax at 25%. So between 288 and 388, the difference is 100,000. 100,000 times 25%, that should be 25,000. That should basically be 25,000. Then the next we have what we call between 388 to 6 million. So our figure total taxable income is not above 6 million. So we just say 5,972 minus 388,000. That difference we multiply by 30%. We multiply by 30%. So we are going to have 5,972,000. Then we minus 388. Then we minus 388. So that should be 5,584,000. Then we multiply by 0.3. So what do we get? We get a figure of 1,675,200. So when you add all those, we get what we call the gross tax. The gross tax payable. The gross tax payable. So we add those figures in order to get the gross tax payable. So 28,800 plus 25,000, then plus 1,675,200. So what do we get the gross tax? The gross tax is 1,729,000. 729,000. Then we less what we call less the tax credit. Less the tax credits or set off. So Musioka is a resident person. So one of the set off is basically what we call the personal relief. Personal relief. On that tax table is basically provided down there. It is provided that should be 28,800. We less that. Then again, the next one we are told, the next tax credit, we also add a payee. Look at the payee that we had. Payee was 120. So that should be payee. That should be 120,000 times 12. So 120,000 times 12 as the payee. 120,000 times 12. So for that we have 1,440,000 1,440,000. We have 1,440,000. Other tax credit, if you had a withholding that was deducted from any income, you can less, or if you're contributing to a life cover or education cover, we would have less on that. So then you say we get the net tax payable, net tax payable, net tax payable. So when we less that, we have 17,29,000 minus 28,800 personal relief, then minus 14,40. So what do we have? We have a figure of 260,200 as the net tax payable, as the net tax payable. The other hand, we can have Janet Musioka. Janet Musioka, we get the tax payable, tax payable. So we have the total taxable income. What is the total taxable income? The income that we need to subject to tax, that is 2,286,000. 2,286,000. So again, if you look at the tax table, we use annual because these are incomes for the whole year. So we say that the first 288, we multiply by 10%. So that gives us 28,800. That gives us 28,800. And then we're being told that between 288 and 388, that should be 25%. The difference should be 100,000 times 25%. That should be 25,000. That should basically be 25,000. That should be basically 25,000. Then we have the next, we're told that from 388 to 6 million, we don't go past 6 million. So we have our total taxable income, which is 2,286,000 minus 388,000. Then we multiply this by 30%. So we get the gross tax for Janet Musioka, gross tax. So gross tax in that, we have 569,400 plus 25,000 plus 28,800. So we have the gross tax to be 623. That should be 623. That should be 623. 623,200. We have it as 628,200. Then we less what we call less the tax credit, less tax credit, the tax credits. So because it's redundant, we have what we call personal relief. Personal relief. So personal relief in this case should be 28,800. There was no pay. We're not told that there was a pay that was affected as per regard. So there's no pay. Neither do we have a withholding tax on any income that was taken. Neither do we have insurance relief. So we simply less that. Once we less that, we get the net, what we call the net tax payable. Since they're taxed separately, they are entitled to a benefit of 2 pay. So we have 623,200 minus 28,800. So that figure should be about 594,400. That should be about 594,400. That should be about 594,200. 594,200. 594,200. That should be about 594,200. That should be 594,200 at the next net tax payable. As the net tax payable. If you look at that question, it's a very good question on employment income. So a question that was, I think the last time before this time it was set, that was April 2023. Before April 2024, it was set in April 2023. The same question where you have husband and wife, and in both cases, they're being taxed separately. They're being taxed separately. Something that's to look at. When is the husband, when is the wife's income being taxed on the husband? You know, we have when a wife works in a company that the husband holds more than 12.5% of the share. In that case, the wife's income is going to be taxed on the husband. And that basically implies that they're only going to enjoy only one personal relief. That is how we basically tackle the last question. That is question 3C. And that is a very, very good question. That marks the end of our session. God bless you. We'll see you in the next session.
Purpose of accounting. Purpose of accounting. Now that you've understood the meaning of accounting and the nature of accounting, can you please give me 5 reasons why you think accounting is important? What is the purpose of accounting? Can I hear from you? Can I hear from you? Helps in decision making by the users. In other words, accounting facilitates decision making. That is true. 1, facilitates decision making. Accounting facilitates decision making. That is true. And that we even saw in the definition. To aid decision making, to facilitate decision making by the users. Because candidates, by offering insights into profitability, liquidity, solvency, accounting enables stakeholders to make informed decisions. Because if you are to consider, for example, the income statement, the users can be able to tell or to make decisions based on, say, income statement, because the income statement helps the users know the profitability status, the financial performance of an entity. The balance sheet can help the users understand or know the financial position of the entity. And that can aid decision making. They can make decisions based on this financial information. So it facilitates decision making by the users. Facilitates decision making by the users. That is a good point, Mr. Silas Owiti. Accounting candidates also provides financial information. Provides financial information. Accounting provides financial information. It provides financial. Accounting generates and presents financial information about a business operations, about the financial position of a business, about the financial performance of a business. It also provides information on cash flows. And such information is essential for understanding the economic health and performance of an organization. Because it is through accounting that we get, for example, the income statement that helps users understand or know the profitability of an entity. It is through the statement of financial position that the users can understand the state of affairs of an entity. That information is important in enabling users to get information, okay, through accounting, which you recall we said is based on quantitative and monetary. Okay, it is, we said is based on quantitative data, and that data can be represented in monetary terms. So it provides financial information about an entity. It facilitates decision making, provides financial information. What else? Another point is that accounting ensures accountability. ensuring accountability. Ensuring accountability. Accounting establishes a system of checks and balances to ensure transparency and to prevent financial misconduct. For example, you may have internal controls, okay, which prevents and detects errors and fraud within an organization. We may also have external audits, which is the independent verification of financial statements to ensure reliability and compliance with accounting standards, and so on. Accounting also helps in measuring performance. Measuring performance. Measuring performance. Measuring performance. Accounting provides a framework for evaluating the success of a business by tracking its financial progress over time. And that allows for performance comparison against industry benchmarks and competitors. Do you understand? Another purpose for accounting is measuring performance. Do you understand? Number 5, the 5th point is in relation to communication. Communicating financial results. Accounting helps in communicating financial results. The reason why an organization may engage an accountant to help in the accounting tasks is so that the financial results may be communicated. Accounting acts as a standardized language for communicating financial information to various users. Okay? Accounting does what? Acts as a standardized language, because accounting itself is a language. And that language is to communicate financial information to various users, and that fosters transparency, and also it enables stakeholders to understand the financial implications of business activities. So accounting facilitates decision making, provides financial information, ensures accountability. Accounting measures performance. Accounting also communicates financial results. 1, 2, 3, 4. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. There are other reasons why accounting is important, but among the many reasons, we have identified 5. Now, considering doing an illustration in the remaining time, December 2023, question 2B. December 2023, question 2B. Scores Limited has experienced stockouts occasioned by the company's poor inventory estimation techniques. The company has therefore engaged you to estimate its demand for the year 2024. The company's accountant had started using regression analysis and availed the following information to you. The demand for the company's product is dependent on disposable income and price of the products. Number 2, the analysis of variances table. The analysis of variances table, we have a source of analysis, you have model, there is error, another column there is degree of freedom, and sum of squares. Number 3, the parameters estimates, the parameter estimates and the errors. 1, we have a column there for variable estimate and standard error. We have constant We have price and price. Required: develop a regression equation that will be used for prediction. Roman 2, determine the coefficient of determination. Interpret your results. Roman 3, test the adequacy of the model for prediction. F table's value is 11.56. It was quite direct, this one. It was quite direct. Develop a regression equation. First of all, you have to put down the regression equation. Then you insert the inputs. Multiple linear regression allows one to determine the effect of more than one independent variables on a particular dependent variable. So there are more than one, multiple predictors. Multiple predictors. So Scotts Limited has experienced stockouts occasioned by the company's poor inventory estimation techniques. The company has therefore engaged you to estimate its demand for the year 2024. The company's accountant had started using regression analysis and availed the following information to you. Number one, the demand